Welcome to my channel. I'm Scott, and in this video we're going to cover 5 airline stocks. The companies we're going to look at are Southwest, Delta, Ryanair, United, and American. The airline industry offers air transportation and travel services for people and also for cargo. Some of the main services offered are flight transportation, aircraft leasing, hotel booking, and car rentals. As the surge of COVID-19 has subsided, many airlines have seen bookings grow at a fast pace. Unfortunately, the price of jet fuel has surged recently following Russia's invasion of Ukraine. This may hurt the margins for the airline industry. Some of the companies we're going to look at fly all over the world. Some airline companies fly within one country, and other airline companies fly within a specific part of a country. The first company we're going to look at is Southwest. Their latest financials are as of 3/31. This is a large cap company, 26 billion market cap. They're trading at $43 a share, and they have 593 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow was strong in 2019 at $3 billion. It was negative in 2020 due to COVID, but they managed to have a pretty good amount of free cash flow in 2021, $1.8 billion, and also $1.8 billion in the trailing 12 months. Free cash flow is the cash that's remaining for you, the investor, so a company can pay a dividend, buy back stock, pay down debt, or invest back into the business. Net income is the profit or loss on the income statement. It's revenue minus expenses. And they had a big negative in 2020, positive in the other years. Revenue is the sales for the company, and that is down 18% from 2019 to the trailing 12 months. But it seems likely in 2022 their revenue will be higher than 2019. Their weighted average cost of capital ranges from 6.3% to 7.2%. That's according to Finbox. I'm going to use the middle WACC for all the companies in this video. The WACC is a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $53 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $48 billion. We divide that by 593 million shares. And we get a calculated stock price of $81. They're trading at $43, so they're trading at a 46% discount. It's a buy according to the model. Most companies provide revenue targets for future years. Their revenue target for 2024 is $28 billion. For 2023, it's $26 billion, and for 2022, it's $24 billion. And to calculate their 2025 revenue, I just grew it at a similar pace, and I got almost $30 billion. On average, they convert 8% of their revenue into free cash flow, and the way you calculate that, you sum up these 4 free cash flow numbers, and you divide by the sum of these 4 revenue numbers. That comes out to 8%. So I multiplied that number by their future revenue estimates. That's how I got their future free cash flows. The website Simply Wall Street values the company at 105. They're saying it's 59% undervalued. 15 analysts priced this stock, and the average price target is 54, the lowest 34, the highest 72. If you put $10,000 into this company 10 years ago, you'd have $55,000 today. That's a 19% annual return, or a 450% total return. This is where the stock has been trading the last 5 years. 5 years ago, the stock was over $60 a share, and then during the COVID crash, it fell below 25. It came back up to about 60, but in the recent bear market, it has come down to 43. So it's still trading well below its pre-COVID levels. The next company we're gonna look at is Delta. This is a large cap company, 24 billion market cap. They're trading at $38 a share, and they have 641 million shares outstanding. Really good free cash flow in 2019, really weak in 2020. They did have a small positive in 2021, but they're back to negative in the trailing 12 months. They did have positive net income in 2021 and the trailing 12 months. Of course, a big negative in 2020. Their revenue is down 25% from 2019 to the trailing 12 months. Their WACC on Finbox ranges from 8% to 9.3%. I use the middle WACC, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $64 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $55 billion. We divide that by 641 million shares. And we get a calculated stock price of $85. They're trading at $38, so they're trading at a 55% discount. It's a buy according to the model. Their revenue target for 2024 is $52 billion. 2023 is $50.5 billion. 2022 is $46.5 billion. And I just continued that growth into 2025 and I got $53 billion. That's how I got their future revenue estimates. In 2019, they converted 7% of their revenue into free cash flow. So I multiplied their 2023, 2024, and 2025 revenue by 7%. That's how I got their future free cash flows. And since they had negative free cash flow in the trailing 12 months, I gave them 0 in 2022 to be conservative. The website Simply Wall Street values the company at $81. They're saying it's 53% undervalued. 13 analysts priced this stock and the average price target is 52, the lowest 42, the highest 70. If you invested $10,000 into this company 10 years ago, you'd have $41,000 today. That's a 15% annual return. A 314% total return. And this company was trading above $60 before COVID, then it fell to about $20 a share. It did come up to $50, but it has regressed since then. It fell to close to $30 at one point. Now it's sitting at $38. The next company we're going to look at is Ryanair. And this is a large cap company, 18 billion market cap. They're trading at $81 a share and they have 227 million shares outstanding. They report all their financials in euros. I converted those numbers to US dollars since we're looking at the ticker that trades in the US. They had positive free cash flow in 2019-2020. The big negative was in 2021, a small negative in the trailing 12 months. Same thing with net income, positive in 19 and 20, negative in 2021, and a little better in the trailing 12 months. Their revenue is still down a lot, 51% from 2019. Their revenue in the trailing 12 months is up more than 100% from 2021. Their WACC on Finbox ranges from 8% to 9.5%. I use the middle WACC of 8.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $18 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $15 billion. We divide that by 227 million shares. And we get a calculated stock price of $66. They're trading at $81, so they're trading at a 22% premium. It's a sell according to the model. Their revenue target for 2025 is 12.9 billion euros, which is equal to 13.4 billion US dollars. The year before that, their target is $12 billion. Before that, it's $10 billion. And I continued a similar growth into the fourth year and I got 14.7 billion. That's how I got their future revenue estimates. In 2019 and 2020, they convert on average 8% of their revenue into free cash flow. So I multiplied their future revenue estimates by 8%. That's how I got their future free cash flows. Although in 2022, I gave them negative free cash flow to be conservative. The website Simply Wall Street values the company at 145. They're saying it's 43% undervalued. Only one analyst priced this stock and that price target is 125. If you invested $10,000 into this company 10 years ago, you'd have $29,000 today. That's an 11% annual return. A 190% total return. This is where the stock has been trading the last 5 years. About 2-3 months ago, it was trading above 120, which was its peak back in 2018. The price has decreased about 35% since that peak. So if you bought this stock at the end of 2018, you might be flat right now. The fourth company we're going to look at is United. This is a large cap company, 14 billion market cap. They're trading at $44 a share, and they have 327 million shares outstanding. Their free cash flow is 2.4 billion in 2019, a big negative in 2020, a small negative in 2021, but nearly 1 billion in the trailing 12 months. Net income looks good in 2019, but big negatives after that. And their revenue is down 33% since 2019. But it did grow a lot from 2020 to 2021 to the trailing 12 months. Their WACC on Finbox ranges from 9.8% to 11.5%. I use the middle one of 10.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 31 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $28 billion. We divide that by 327 million shares. And we get a calculated stock price of $85. They're trading at $44, so they're trading at a 49% discount. It's a buy according to the model. Their revenue target for 2024 is $51.5 billion. For 2023, it's $49 billion. For 2022, it's $42.7 billion. And I calculated $54.3 billion for their revenue target for 2025. In 2019 and the trailing 12 months, they convert 5% of their revenue into free cash flow. So I multiplied their future revenue estimates by 5%. That's how I got their future free cash flows. The website Simply Wall Street is really high at 128. They say the stock is 66% undervalued. 16 analysts priced this stock, and the average price target is 60, the lowest 38, the highest 87. If you put $10,000 into this company 10 years ago, you'd have $20,000 today. That's a 7% annual return, a 98% total return. This is where the stock has been trading the last 5 years. So pre-COVID, it was well over $90. It has broken through 60 at one point since COVID, but it's hovering around the $50 point for the past 12 months. The last airline we're going to look at is American. This is a large cap company, 11 billion market cap. They're trading at $17 a share, and they have 650 million shares outstanding. They had a negative free cash flow in 2019, a really big negative in 2020 due to COVID. But they did manage to get a positive free cash flow in 2021 and the trailing 12 months. They had solid net income in 2019, a big negative in 2020, 2021, and the trailing 12 months. Their revenue is down 24% from 2019 to the trailing 12 months, but it's up about 15% from 2021 to the trailing 12 months. Their WACC on Finbox ranges from 9% to 10.5%. And I use the middle one of 9.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 39 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $30 billion. We divide that by 650 million shares. And we get a calculated stock price of $46. They're trading at $17, so they're trading at a 64% discount. It's a buy according to the model. Their revenue target for 2024 is $52.5 billion. For 2023, it's $50 billion. For 2022, it's $46 billion. And I continued that growth into 2025, and I got $55 billion. In 2021 and the trailing 12 months, they convert 1% of their revenue into free cash flow. So I multiplied their 2022, 2023, and 2024 revenue by 1%. That's how I got their free cash flow for those years. And they should be converting about 5% of their revenue into free cash flow. So I multiplied their 2025 revenue by 5%. That's how I got the free cash flow for that year. The website Simply Wall Street values the company at $59. They're saying it's 72% undervalued. 13 analysts priced this stock, and the average price target is $19. The low is $9, the high is $26. If you invested $10,000 into this company 10 years ago, you would have been at $60,000 after about 6 years. But if you're still holding on, you'd be at $17,000 today. That's a 5.6% annual return, a 73% total return. This is where the stock has been trading the last 5 years. It was close to $60 in 2018. and it just kept dropping since that point. It did bottom out during COVID and came up a little bit, but still trading well below its pre-COVID levels. There are 22 stocks in the airline industry, and we looked at the top 5 in terms of market cap. All 5 companies spend more on CapEx than the average company. Delta spends the most at $4.6 billion. Southwest and Ryanair have a good debt to equity ratio. Delta and United are above 11. That means for every dollar of equity, they have $11 of debt. And we can't look at American because they have negative equity. And no companies in the airline industry pay a dividend. Delta and Ryanair still have negative free cash flow. Southwest has a lot at $1.8 billion, more than anybody else in this industry. United and American are doing okay as well. All 5 companies have a worse price to book ratio than average. We can't look at American because they have negative equity. Price to book is market cap over equity. All the companies have a worse PE ratio than the average in the industry. Southwest and United are doing well in price to free cash flow. American is doing okay. We can't look at Delta and Ryanair since they have negative free cash flow. Ryanair is doing the worst in price to sales. American is doing the best of the 5 companies we looked at. All 5 companies generate a good amount of revenue except for Ryanair. They're pretty low at $3.9 billion. And all 5 companies have declining revenue in the past 3 years. ROA is net income over assets. Southwest and Delta are positive, the other 3 are negative. ROE is net income over equity. Southwest and Delta are doing fine. Ryanair and United are negative. And this should actually be NA for American, because ROE is net income over equity. They have negative net income and negative equity. So it looks like a positive 30%, but it should be NA. Here are all the company stock prices on the same chart. And you can see they're highly correlated. If one goes down, the other goes down. If one goes up, the other goes up. And they move pretty much in the same exact direction. In the past 5 years, American Airlines has done the worst, down 63%. United down 44%. And the other 3 are down in the mid to low 20s. So to summarize, of the 5 companies we looked at, only Ryanair I say is overvalued. The other stocks seem really undervalued. All 5 stocks, according to the analyst, are undervalued. Same thing with Simply Wall Street, all are undervalued. Excluding the cruise line industry, the airline industry has gotten beat up more than anyone else. So this could be a great time to get in on some of these stocks. I would feel more comfortable investing in Southwest and JetBlue. Their business model seems more effective than most other airlines. The big airlines like Delta use the hub and spoke model. And that could be a pretty inefficient model because if there's one delay, it could delay many other flights. Where a company like Southwest uses a point-to-point system. So if there's one delay, it only delays that flight. It doesn't affect any other flights. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.